Welcome to the Commercial Real Estate Podcast powered by First National. I am Adam Pawadic, sitting here with Aaron Cameron at the first conference of the year for us anyway, the RealCapital Conference. This is, of course, part of our speaker video series sponsored by KingSett. We've got our second guest of the day. We've interviewed him before, but I don't know if it actually was on our podcast channel. I think it was a different platform. So first time podcast guest, first time speaker video series guest.
First time in person, actually. This is the third time we've interviewed him, but twice was virtual. So welcome.
So yes, who is it? Carl Gomez. He is the chief economist and head of analytics, CoStar Canada. Welcome.
Thanks very much, guys. Good to be here in the flesh.
Yeah, you have depth. Well, we as we always do before we go live, we always ask the guest, what do you want to talk about? And Carl goes, whatever, anything, everything. Like the scope is beyond, which is challenging. It's nice to often when you have a guest that's like, oh, I do this. I'm an ESG specialist in office. It's like, okay, cool. Let's focus on that. Yeah. With Carl, the knowledge is broad, right?
Just a little bit of everything.
And not just an opinion. It actually, it's backed up with research and data.
Yeah.
So
this is not based on a Globe and Mail article that he read, right?
This is all about data. Yeah. Work for a data company.
Yeah. So where do you want to go first? What is, I think, let's just do top 5 sort of most interesting trends, interesting things that you're seeing and feeling in the marketplace right now.
Well, I think, coming off the panel, one of the, the mantra last year was survive till 25. And there was this view that there would be general recovery happening in Canada with transactions, with pricing, valuations, everything in 25. So it was like 24 was a tough year, but the Bank of Canada is cutting rates, hefty, 50 basis point cuts a couple times. That's going to unlock the animal spirits and get people going. And sure enough, when you check the mood these days and even look at, coming off of transaction activity in the commercial real estate market last year, relatively low, 2-3 years of successive decreases. It doesn't look in the first couple months of this year that things are going to pick up. So it's kind of interesting why that's the case. And
tell us, Carl, why?
I think the easy answer is obviously we're dealing with a new president who's thrown a lot of uncertainty Canada's way. We have these tariffs standing in the wing that could be a material issue for uncertainty, and investors hate uncertainty. It's risk off, they hold capital. So that's the easy answer. And it's obviously not an easy solution, but it is the easy answer, is that there's that uncertainty. But I think the bigger answer is more fundamental than that, is that there was this expectation that as the Bank of Canada cut interest rates, that we would be back to an environment that we were used to for the last 20 years, where lower interest rates, liquidity in the market, lots of capital means that people can just start chasing real estate and putting money to work again. And that hasn't been the case.
How many times do you have to explain that there's a difference between short-term rates and long-term rate?
Yeah, and that's the thing. Like, I'll wear my economist hat here and say, I worked in real estate for 25 years, but prior to that, I actually worked on a trading floor with bond traders. And, people automatically think when the Bank of Canada cuts interest rates, all interest rates go down. That is not how the market works. Most of the yield curve, the longer-term securities, the bonds that form the basis for the cost of capital for everybody, every other asset class, including real estate and equities and everything else, is determined by what the market is doing. And there, where we looked at fixed rate, bond yields, the market is not absorbing the full impact of those rate cuts. And that's why I think, from a fundamental level, there is something more going on here with a reset with 10-year Government of Canada bond yields taking its lead off the U.S. Treasury. We are coming out of, 40, 50 years worth of declining interest rates. And we went to levels that were too low, in my mind, because of a lot of risk that was going on in the market. And that deteriorated the term structure in those bond yields, not to get too technical. But today, we're actually reverting back to the norm that we knew prior to these couple of years. And, our careers were built in the last 30, 40 years. Some people only have a window of 20 years where cap rate compression just let us, invest. And now we don't have that wind at our sails anymore. I think with bond yields normalizing, it forces us to have a rethink. So I think that's something that I think a lot of the optimism came from last year, was built off of the fact that in the last 20 years, whenever the Bank of Canada cut, it created cap rate compression, which I don't think is going to be the case this time.
Well, let's talk about, you mentioned briefly tariffs. We should date stamp this because a guest like Carl is a timely one in that if we record now and release this 6 months from now, you could look very foolish or very smart, but
Right.
we'll release it very quickly for that reason.
Right.
Because, we get out there. But we are end of February.
Yep.
Trump has announced that tariffs are going to take place late March 4th. I saw
Yep.
in the papers. Your view on the impacts if that does go ahead for a prolonged period of time.
Well, and Trump said this yesterday in the news. He's still on for doing it the first week in March. So look, the Bank of Canada, all economists have all kind of looked at the impact of a 25% tariff, 10% on energy, impact on Canada. Bottom line, that's going to cause Canada to go into recession. We are an open trading country. 70 to 80% of what we trade goes to the United States. That's a significant cost to the economy, to the producers of that stuff. At the same time, it forces the economy to restructure. The lines of how supply chains work across North America would need to be realigned. You put that all together, and the Bank of Canada has already done this study in a hypothetical sort of way. A 25% tariff across the board would cause GDP to contract by at least 3% from the top to the bottom. So that's effectively recession. We're bracing for that. It's not the base case scenario. And certainly when I talk about interest rates, the Bank of Canada cutting, this is an emergency situation yet. The base case says Bank of Canada might be cutting maybe 25, 50 basis points more and then hold around 2.5%. If Canada's facing a recession with these tariffs that absolutely would cause that to happen, the Bank of Canada would need to step in the way. They'd have to use the only tool that's possible to help absorb such a shock as that, like they've done during COVID, like they did during the GFC, and drop interest rates. The key difference, though, that I see in that kind of environment is also the impact on inflation, because those costs are going to be passed back to consumers, both in Canada and the United States with tariffs. That could cause a reset in prices. So we may be in an environment of stagflation where growth is slow, inflation picks up. This was certainly what made the Great Depression great, was the impact of these tariffs. And so I don't think interest rates on its own, like nobody should be wishing for tariffs so that you get interest rates down. This is the mentality of where we have to look at the dynamics. But it's a very dire scenario to see that those tariffs kick in. What it's done in my mind, though, is it's also caused Canada to have to reevaluate our growth strategies. Tariffs are a huge friction on business. Canada's got some self-imposed frictions that we could easily start to work on. One is bringing down interprovincial trade barriers, which would unlock the ability to trade. The other one is to improve our productivity. So not just to rely on, making stuff or, pulling out things out of the ground and giving it to the United States, but creating value add. So I think this is a little bit of a come to Jesus moment for Canada as an opportunity, whether these tariffs happen or not, to fundamentally look at its economy. What that implies for real estate, however, is a whole other discussion, because right now, generally speaking, fundamentals are pretty good in the real estate market for most of the, core asset classes. But a tariff, at the proportion that the Trump administration is talking about, is going to realign supply chains. And right in the line of fire, to me, would be one of the asset classes that, people has been a darling for a while, is industrial. A lot of two-way trade that goes on between Canada and the United States uses those industrial buildings, particularly here in the heartland of the GTA, as a servicing device for that. So there will be a lot of uncertainty for people who are involved in the supply chain channels. That's going to flow back into demand on the industrial side. So I think there are risks there. I also think there's risks for a whole bunch of other asset classes, whether we talk about office and, the propensity to invest and hire for people and create demand for office investments. There's that. There's also risks around, unemployment going up and the propensity for people to even afford to rent. And we'll talk about the apartment market in a second, but for a lot of Canadians right now, whether we're talking about housing and ownership or renting, it's unaffordable and it's tough. So, that is the risk.
Add inflationary pressures on that.
100%.
Add higher unemployment.
Yeah.
Well, related inflationary pressure, Trudeau's talked about providing COVID style relief to people impacted by tariffs. What's your view on that strategy for sustaining the economy, or at least his voter base?
Well, I think, not to get political, but Trudeau's solution was always just throw money at a situation. He did that de facto in the fourth quarter with the vibe session that we were having, the GST, HST holiday, which is just basically, spending money at the end of the day, taking away what most economists see as a good tax basis. So spending money, yeah, sure, he'd have to do that. But let's talk about what the impact is going to be. Bond markets, I talked about in a second or earlier, were already realigning and driving interest rates higher because of the term structure coming off, that term discount that was there. And the reason why it was doing that was post-COVID, we've seen a lot of spending by governments. They've increased the amount of borrowing that they're doing in Treasury, in Canada, with all of that. All that's going to do, more spending, is going to continue to push up the long-term rate of interest. And that continues to put it, this money isn't free. And so the cost to that is the yield that you have to pay for, spending that money that Trudeau doesn't have.
How does that impact the curve?
Well, I think what we are seeing right now, we came out of COVID with an inverted yield curve, meaning that short-term interest rates were way higher than they should have been. I was a I was a critic of the Bank of Canada policy. I think they pushed short-term interest rates way too high because of that threat of inflation that came out of COVID. That inflation that we saw coming out of COVID was not due to the printing presses and a lot of money. Some of it was, but a lot of it was basically supply chain cost pressure and
pent-up demand, probably.
Pent-up demand at a time when costs, the supply chains were kind of still in shock coming out of COVID. That created pressure on prices. But the Bank of Canada pushed interest rates way too high in my mind. It actually choked a bit of the Canadian economy as they did that, which is why they had to do those big 50 basis point cuts to get back to a more neutral level. So what they've done by cutting those rates is they've actually helped to flatten the curve. That's helped to unlock some liquidity. But I think we need to go to a steeper yield curve in an environment where long-term rates aren't going to be coming down all that much, for the Bank of Canada to shorten short-term interest rates a little bit more and create a little bit more liquidity. I think that's the hope that we need to keep the economy going, and that's where the bias, in my mind, is where the Bank of Canada will be.
Jumping around a little bit, you talked about just supply chain disruptions and you referenced industrial. Let's sort of now pivot to apartment market and talk about the impact on markets. We talked a little bit about inflationary pressures or potential inflationary pressures on the rental rates. We've obviously got a supply challenge right now, and there's a lot of development, future development. Not sure the math is making sense right now, but there's a hope that it does. What do the tariffs do on a lot of the inputs for development?
Well, we've seen a couple articles on this. Obviously, in the supply chain to build housing, residential housing, but in general, just building housing, a lot of those tariffs are going to just make the cost of housing more expensive. And, when we talk about the supply shortage of housing, a big factor of that has been that the costs have gone up. And by virtue of that, house prices have gone up as well. And that's caused a lot of Canadians to take on debt. And so we've been leaning on the housing market to keep us going. But the demand and supply, there's a disequilibrium in the market being created by this artificially. So putting more pressure on the cost of housing in the face where we need more supply will only create more dislocation in the market. Something needs to break in order for that equilibrium to come back. So tariffs right now, wrong time to do it. Pivot back to the housing market. Although we still need a lot of supply, the one factor that I think a lot of people don't see is that a lot of the shortages in housing that we're dealing with in Canada is actually in single-family housing. We aren't building the same amount of single-family homes that we did 20, 30 years ago. Part of that reason is just legislated. We've legislated ourselves into scarcity of single-family homes. And as a result, most of the affordability pressure is on the single-family home. And most people who come to Canada, most people who live in North America want that white picket fence, want a single-family home. And that's where the affordability challenges are. On the flip side, we are building a lot of multifamily housing. One thing that I think a lot of people don't realize is right now the contribution from residential investment to the GDP is at record levels in Canada. It's close to 10% of GDP. That's higher than any other developed world any other developed country in the world. So we are building lots of housing, and the reality is, because we're building more, bringing more people in, we need more of it. But we're already pushing so much resources in the housing market that has a long-term impact on the economy. What's the solution to this? Well, I think there's two areas that we have to kind of look at in Canada: is trying to build housing more productively. Right now, we're not making it more productive. We are actually
What does that mean specifically, productively?
build more without spending more.
Okay.
Right? So produce more for each, bang for your dollar.
You're saying lower taxes.
Exactly. So there's frictions in building. So I think, some of the frictions that stem from the municipal level, from taxes, could really help unlock supply. So I think that's a big factor. But the other factor too is just in the way we build housing is create more technology to build the same. So modular housing, developments around that. Also the inputs when it comes to the cost of labor. You brought a lot of people into the country, but back in the 70s, we brought in tradespeople and people could help build housing. That's not what we've been doing from a policy standpoint too. So I think those are two big factors that need to be addressed in the housing crisis. But I come back to the point that we actually have an oversupply of housing right now. If anybody looks at the multi-res market, the condo market specifically in Toronto, there's going to be a lot of units dumped onto the market in the next couple of years. And the pre-sales were going well when interest rates were low, but now we have a lot of the investors who are in that condo market who are dumping the pre-sales. That supply is still going to come into the market, and there's an excess overhang of that supply. That excess overhang of supply is going to continue to put downward pressure on condo prices in general and housing prices in general. But it's also, and we can talk about this a little bit, a lot of the people who are going to be left holding these buildings, who are investors, instead of looking to flip them later on, they're looking to lease them, get some cash flow back. They're negative cash flow. That's adding to the rental supply that's already in the market. We have a huge excess amount of condos that are coming onto the market to be rented at a time when we're also building now record rental construction as well. And so it's not surprising to me that even though we have a very tight market, we are starting to see average rents starting to soften quite a bit from their post-COVID 7, 8, 10% level. We're down to 2% in my mind, and we can talk about what the other drivers are, but I think rent prices and rent levels are actually going to continue to fall over the next year for a number of different factors.
In Vancouver and Toronto predominantly.
Yeah, when I talk about this, not to be too Toronto-centric, but it is a very Vancouver-Toronto situation.
Yeah, and that's just the reality of the two major urban centers.
Yeah.
We are seeing some rent softening, stabilization, let's call it, in Montreal.
Yeah.
Perhaps a little bit in Ottawa.
Yeah.
But Halifax, and in Halifax, to be fair, I think we saw massive growth in rents in Halifax, but it really, the softening and the what you're talking about, just the supply that's coming on market, is really a Vancouver, Toronto centric issue.
Yeah.
What if we look just beyond the absorption of all these units? Because currently there's nothing starting, there's no new projects starting in the condo space. Obviously, apartment does continue on.
Yeah.
2-3 years from now, there will not be new condo supply coming on. Will we see a rapid increase in rents at that time if you then run into a situation where there is no new shadow market rental coming on stream?
It's a good question, and on the face of it, I think when you just look at it from a very high level, that would make sense, right? There's a shortage, rents should go up. But when you look at it from the standpoint of how you can develop, and this comes back to the cost. And when I worked in development, you'd perform a development, you'd need to start to build somewhere at about $4 or $5 a square foot, maybe even higher now in Vancouver, in order to make some sort of profit in your development. So you're underwriting a $4, $5 rent. And I've heard from some developers, you're also underwriting 3, 4, 5% growth at the tail end in order to get those profits. The thing about that, when you look at $4, $5 rents, is that when you scale that up to the size of the unit and compare that to household incomes of renters that are there, that's not affordable. And I think that's one reason why we're seeing pressure on rents. And one of the data sets that we look at CoStar is newer multifamily rental buildings that were built post 2020, which carry higher rents, are actually seeing vacancy rates closer to 10% than they are to 0%. The 0 to 2% vacancy rate that everybody quotes about Canada is basically in units that were built before 2020, and especially in units that were built before 1990. Those older buildings are also rent controlled. So they're a lot more affordable for people, and that's why everybody's gravitating to them. The newer units that are being built are priced a lot higher. Certainly there are a lot of amenities and everything else, but they're not affordable for a lot of people. You need 100,000, 120,000. There's a niche set in Toronto. There's a niche set in Vancouver that can afford that, but there's a big missing middle that cannot. And that missing middle, and we've talked about this in the multifamily business for a long time, wants larger units because they have families, they need to live, they can't live in shoe boxes. And that need is where I think the supply challenge starts to come out.
Because you can't build to that market.
You can't build to that market. So
Not affordably, not profitably.
Not profitably. And that's where I think the biggest challenge is we have a supply problem, but we have a supply problem of building affordably. And I'm not talking about affordable housing. That's a whole other wax. But I'm talking just for the average person. In the United States, go to Texas, you go to the Sand States, you can do that. And that's why the market goes up and down with supply. And quite frankly, you can actually earn a return as a developer on that, like if you pick your timing properly. But it's much more of a challenge in markets like Vancouver and Toronto, where you're dealing with that constraint. Less so in Calgary. And Calgary works a little bit more like a Texas that way. But I think that's the challenge in this environment.
But partly the lack of rent control in Alberta.
It comes to, and I kind of went around in a circle to talk about that. But I think the reason why we have these disequilibriums in the housing market is due to policies such as things like rent control. Rent control creates scarcity in the long run because you're controlling a price, which is the mechanism to unlock supply and demand in a well-functioning market. And now we're paying the price for that in an environment where we could have skirted over that during an era of low interest rates because it saved on costs. But as interest rates start to go up, that problem just gets magnified.
Would you recommend the Alberta model for the rest of the provinces?
Yes. I think housing should be delivered in a free market environment. The spirit of rent control makes a lot of sense, but look at the market right now. It's kind of funny. So rent control stuff, the rents are actually being pushed to go up to 2.5%. Non-rent control stuff, I'm seeing instances of rents going down. So that the market can kind of satiate the situation.
Yeah. Unfortunately, we are seeing more noise about rent control.
I know.
In Alberta, right? We're hearing about more tenant activist groups being more noisy, being louder about just the need for that control.
And that's the politics of these sort of situations. Is the loudest voice gets the chalice, gets the chamber, and. The people who are on tenant action committees to drive rent have a very loud voice. They are very well politically aligned and supported and motivated and be able to channel that. So the spirit of that is moving the pendulum more that direction than it should be the other way.
What's the good news in the data right now?
Good news in well, we talked about a little bit about the office market, and everything in my mind, asset class wise in Canada for core assets is pretty much priced for perfection. Apartments as well. I mean, we're still seeing cap rates going in yields 4 or 5%. And that's predicated on the fact that, with spreads so thin with the risk-free rate, you can make that up with rent growth. But is rent growth going to be there? Industrial is the same sort of story. Everybody wants beds and sheds. Industrial, we came out of a period of 20% year-over-year rent growth. But at this point in time, probably not going to see much more than inflationary sort of rent growth in the industrial market. There's a huge challenge there with supply in the industrial market too. But we're probably not going to see that kind of rent growth happen in Canada for various reasons. So most of the principal asset classes look like they're priced for perfection. There's less opportunity there on a buy and hold sort of environment. Where I see the opportunities is in asset classes where the pricing is now starting to change. And one of the asset classes that's happening is office. Lenders have created that environment. They've created it more in the United States than they have in Canada because of our conservatism. We don't take those changes and revaluations very quickly, just the way capital markets work. In the United States now, great office buildings are now going in yields of 7, 8, 9%. To an investor, that's a great buy, because now you can start building value off of that great going in yield. In Canada, we haven't quite got there yet, but we are starting to see that sort of adjust. So there is value there. The other area that I see in capital flows are reflecting this is capital flows into retail. And, there was always that scare about e-commerce and things like that. But people need to eat. As much as they need housing, they need to eat. And good, solid grocery anchored retail continues to pay, pays the cost. There's a yield that's there. It's a solid asset. You know how to manage it. You can mine that out. But there's also lots of retail that you can reinvent, that there's an opportunity to get value add and a bit of an alpha on that as well. So I think, interestingly enough, a lot of investors have been shying away from office and retail. I'll take a contrarian view and say, because they've shied away, there's a little bit more opportunity there.
Is part of that because they've been kind of at the bottom of the totem pole for a longer period of time, so that bid-ask spread is just it's had longer to adjust and match up?
100%. I think that's exactly it, is that bid-ask spread now is people's impact when they look at the market and on a deal are coming to the table in a better way than probably where the expectations are for those other assets.
For industrial and apartment, it's still a little bit, you're still a bit too keen on what you think your assets were.
The seller has an expectation. The buyer obviously has a different expectation. So I think that's causing a little bit of the standoff. I think in Canada, the office market is still there. There may be, the assets that we've seen trade in the past couple of years in the office market in Canada are some of these suburban, smaller assets. They're not the bigger assets that we're seeing trading in the United States. And so maybe the owners of those assets that may want to get out of those bigger assets aren't willing to let it go at a certain price either. So there is still a little bit of a disconnect there between buyer and seller expectations on larger assets in the office market, but that's not been the case in the United States. The market is clearing now because the price is cleared. And you hear the brokerages and firms like that are making tons of profit off.
And what does the research suggest on like return to office and occupancy and leasing rates in office space, particularly in the U.S., because let's assume that'll eventually trickle northwards?
Well, interestingly enough, I look at our data. CoStar is an American company, so I have privy to American data. There isn't much difference in the fundamentals between, our fundamentals in Canada and the United States. Leasing volumes have improved in the U.S., but they're still below levels that they were pre-COVID. That's the exact same story in Toronto and in Canada. We've seen an improvement in leasing volumes, but we're still well short of where we were prior to COVID.
Yeah. How many friends do you have that are working 5 days a week in the office?
Hybrid to me is the go-to thing now for any knowledge worker today. Whether you call it hybrid or not, it's still hybrid. We get the technology, we can work from anywhere. I think what's changed is that the employers and the people that are, leasing real estate have now said to themselves, how do I utilize office? And we need to try and find a place where they find an equilibrium, where they stabilize an office utilization. We're almost there based on the stats that I've seen in the surveys, but companies are still figuring out how to utilize the office space. And in that process, we still are seeing lots of office becoming available. There's people who are shedding space. The negative absorption has ended, but there's still a lot of space on the sublet market. There's still a lot of space available. A lot of that is lower class office.
I was gonna say, there's the bifurcation of office, right? Like it is the top end stuff's doing great. The lower end stuff is not.
Even within that, I think that's the selling point or the elevator's pitch. But even AAA buildings that are of an older vintage in the downtown core are seeing the same sort of vacancy as a B-class building. Where the demand has been, from the stats that we've seen, is for newer offices. And I think the new offices carry with them the more flexible floor plates, the amenities, the technology, and the cachet that if I'm going to try and get somebody to come into the office as an employer, I want that newer office. And interestingly enough, in the United States, there's a growing shortage of new offices, which is probably going to kick off the new development cycle there, pretty soon. In Canada, we're coming off one of our strongest development cycles. So we still have to work that off before the office market picks up.
And as you mentioned already, our general Canadian conservatism too is probably
100%.
we're not going to jump back in the deep end of the pool the way the Americans do as quite as quickly.
101%. I mean, conservatism is great and Canada is very stable, but that works itself well on the way down. But on the way up, if you're conservative, you just don't have the time frame to get on that rising ladder.
What inning are we in?
I would say we're in the middle of it. We've still got maybe 7, 8, and 9 to go.
Yeah.
We're getting there. We're almost there. I think the U.S. is ahead of us on that cycle, and that's by virtue of the structural differences in the United States, but it's also by virtue of the fact that their economy is doing far stronger than we are. Their unemployment rate is still very low. There's still a lot of hiring that's going on. So they're actually doing still very well, and that's helping to pull that divergence between Canada and the U.S. much farther. So the old adage of Canada just lagging the U.S., that delta has kind of grown in the last
Yeah, and tariffs won't help.
Sorry?
Tariffs, excuse me.
Yeah. I mean,
Tariffs won't help.
The tariffs are to me, the big black swan shock that, amplifies what's already happening.
So do we need a new saying then? Stay in the mix till 26, something like that? Because clearly it's
That's a good one. Did you make that up?
right now on the fly.
Wow, I'm impressed. Stay in the mix till 26. I'm using that on my panel.
So I said, I was coming up with something like trying to come up with that. I said, I'm still alive in 25 is what I said. But yours sounds more hip,
Stay in
I
the
think.
mix till 26. It's awesome.
Yeah,
there you
absolutely.
go. Coined, trademarked.
Yeah, exactly. Again, I think there's a lot of uncertainty in the market. There's a lot of trepidation. The mood has shifted from where we were maybe a couple months ago because of the tariffs. But I think over time, the fundamentals in Canada are still positive. I mean, we're a growing country. We're a young country. We're an educated country. We're an urban country. Real estate all makes sense on page. And I think foreign investors, people who like Canada, will say that. It's a good place to put capital. But right now in this environment where markets are shifting, there's a revaluation of the world of 5 back to 7, and Canada being slow on that guard means it's taking longer to get there. But also these external risks mean that we're in a period of time where we need to wait for that adjustment to happen.
It's interesting. Like, we're all human beings. And you want to tell yourself, just look through the noise, look through the challenges. Real estate is a long-term gain, right? You have to think about it in 5 and 10 year chunks, but it's so tough when every day there's more sort of fear in the news.
Yeah, and I've sat inside investment committees, and when investment committees sit down, they're as much as they're concerned about return, they're concerned about risk, and that's a big discussion, I'm sure, these days in investment committees, is how much risk are we willing to put out for what kind of return. And I think that's the kind of environment that a lot of investors are sitting on right now. Until you present me a compelling opportunity that justifies the risks that are out there, I'm going to sit on my hands. And capital markets are kind of suggesting that with very thin spreads and everything. I was looking at an article the other day where PE ratios in the stock market and valuation metrics and are sky high. And so equity investors are thinking that too. Like, which stock do I play? Where do I play in that space when things are so tight? So I think for real estate investors, that's the same thing. But we all have a duty to put out capital. That's what our clients are paying us for. So we have to kind of pick our spots.
Carl, I think we've hit the end. Unfortunately, wonderful having you on. Thanks for coming back and doing this. Very insightful, very thought provoking. Really appreciate your insights. I want to thank First National for powering the podcast, and of course, thank KingSet for sponsoring the speaker video series here live at RealCap. Thanks again, Carl.
Appreciate it. Thanks a lot.